there's a lot been like written and talked about these kind of like smaller mid-cap public companies, put Yext in kind of that bucket there. And it seems, from the outside, it seems very, very hard to run these companies as public companies. What is your advice to other CEOs going through it? And maybe your advice is to not do it. I don't know. But what's your advice to other CEOs going through all that stuff?
Yeah, I mean, I think I'm not sure that, in my lifetime, I'm not sure it's been harder to be a small cap public company. Partly because I just think the market doesn't care.
Yeah.
Right. So what's interesting is Yext was a mid-cap public company when it was half its size and way less profitable. Right.
Yeah.
So
back in the day.
Yeah. You go back 5 years, we were literally less than half the size and burning tons of money, and we were worth 5 times what we're worth today.
Yeah. Crazy.
Right.
Yeah.
So there, today, if you again look at sort of the next 12 months consensus and then you do the enterprise value, like, Yext trades for something like, I don't know, it's 4 or 5 times EBITDA.
Yeah.
Right. Like, that's like an unheard of multiple, even for a low growth software company.
Totally.
It just is what it is. Right.
Yeah.
And I think, there are always different options that, teams and CEOs can pursue. What I try to do is not focus on any of that stuff and focus on, if this is a 10-year, 20-year, or 30-year time horizon, what's the things that I do today to create value in 10 years? That's not always an answer that my public shareholders love, because, I think in a lot of cases, their business models rely on returns much faster. And I think that's, the fact that I've been very public and very vocal about that's the lens that I'm going to take, that may cost me some shareholders who are, looking for a faster return.
And how does someone like you think about it? So you've got this business, the business itself is a very good business, super profitable, but not really growing.
Yeah.
It generates all this cash.
Yeah.
So now you go back to your outsiders, like capital allocator hat. You have all this cash coming in, and your job now as a money manager to use that cash in an effective way. Like, how do you think about that?
Yeah. So we think this is something I talk about all the time internally. And with a board, and I talk to our investors about it also, is there's really basically 3 or 4 things I can do with that cash. So one is I can just let it pile up on the balance sheet, right?
And that is really, it's like, well, maybe I'll come up with the idea later of what to do with it, or maybe I need a lot more cash to go do something big, like acquiring something or do something big, and gives me some optionality.
Totally. Yeah. So I think,
certainly Berkshire Hathaway does that a lot. Like, they have the amount of cash in their balance sheet, or Apple or whatever on their balance sheet is just astronomical.
Totally. So I think that's one option, and your enterprise value increases, on a 1-to-1 basis, right?
Correct.
The market generally will value cash at cash. So I think when you don't have anything better to do with it, that's a really good thing to do with it.
Sure.
I think there are at least 3 other things.
Better than spending it on random stuff. Yeah.
Well, it's certainly better than spending it on growth that doesn't materialize.
Correct.
Right. Because that is the worst thing you can do with it. So there is an element of, as a, capital allocation mindset, thinking about like, what does the 10-year DCF valuation of this business look like? If I can accelerate growth through organic investment and be less profitable, and I have really high confidence that I can accelerate growth, then I would be willing to be less profitable in the short term in order to do that. So that's just, organic growth or organic investment of that cash into product initiatives, sales, marketing, R&D, things like that. The second thing is obviously M&A, right? And so I think in an environment where we have tens of thousands of vertical, or smaller software companies who can't raise money for the most part, and who are trying to and have these sort of existential challenges, there's going to be a robust opportunity for us to grow inorganically through acquisition. And if you do that in a really disciplined way, I think what happens is you can expand the breadth of your offering, and you can play into this kind of consolidation theme, right? So if we buy really smartly at really disciplined prices, and it strategically fits into the thing that our customer wants us to do more of, then it allows us to go in and bundle and package and be far more competitive. there are 10 other great benefits to that sort of thing, which is we unify the data layer, which sets the table for a generative AI, and other types of AI wave and all these other things. So I think strategic M&A makes a ton of sense, but it has to be very, very disciplined when you're dealing with sort of your own currency is
and you're gonna want to buy things that are at least quote, break even, and then maybe you have ability to grow that EBIT over time, unless you're really betting on the growth of that.
Well, and that's where I think you just get into a very high risk zone, right? Buying higher growth things that are highly unprofitable puts you into a mode of, it's kind of like saying, company. Hey, we're gonna, which by the way, Yext has a history of doing, and we all were on board with it, and those bets didn't pay off, right? Yep. And they came with downside that we have had to execute through. So, it's no different than saying, me spending $100 million on a company that's high growth and burning cash is really no different than me saying, hey, I'm going to invest $100 million of sales and marketing and R&D into a moonshot product offering that may or may not massively accelerate growth. Yep. It's the same. It's a capital allocator looks at it the same way, right? And then the third thing, which is a really useful thing, is we can return that money to shareholders in one of two ways. A dividend, which is a very unpopular thing for tech companies to do. Although maybe we'll start.
Some of the big ones like Facebook and Microsoft and other ones have done this.
Yeah. And then the more popular certainly and
stock buyback.
Stock buyback. And we've done a lot of this. I mean, we repurchased, I think, since I've taken over, close to 20 million shares, right? Which represents, 15 to 20% of the company's total share count. And how do you I've seen a lot of companies are doing all these stock buybacks, but then they also are at the same time, issuing a lot of options. Yeah. And so it's kind of like, it's this weird, it never really works out. And what the company I was involved with, even LiveRamp, like they did a ton of stock buybacks, hundreds and hundreds of $1 million, but it just never really helped the stock price at all. Yeah, no, I think, so first, I think this idea that like the stock buyback actually moves the stock price, it's, the rules are designed so that doesn't happen. We can only buy so much of the daily float, and like any public company can only buy so much. So you can't really move your stock price, right? I think
you move it in that, over time there's less shares, and potentially those shares are more, especially if the business is doing well, then they all have a greater claim to the future profits, essentially.
That's right. Yeah. Well, look, and again, it goes back to what's your lens, right? So the lens that I ask my team members to think about, and really anyone who owns, who works at Yext and owns shares, is is you're an owner, right? And so while it might be fun to take that money and like pour it into moonshots, right? Yeah. Or, the reality is if we take that money and we buy 10% of our stock back, everybody here now owns 10% more of the company.
Correct.
Roughly. I'm not a mathematician. There's probably, that math is probably wrong. It's probably 9%. It's 9% or something like that.
Yeah.
But
like 11%, depending on which way you go. Yeah.
Yeah. And so in order for that math to work, you have to be more than offsetting the dilution of new issuance, right? Yeah. Which then takes us back to this idea of like, do you operate efficiently or not? Yeah. Right. And the more efficiently
maybe
we operate,
less people, and people are valuing different things.
Yeah. So this thing to me is like a tiramisu, right? It's like what's a 3-color cookie that my kids love so much. They're like the Italian cookies are like red.
Oh, those are delicious. Yeah.
You got to layer these things on correctly in order for them to work, because buying a ton of stock back and then turning around and just issuing a ton more stock, like, it offsets some of that dilution, but like, is that really the best use of that?
And also, and back in the day, you're kind of like relating everything back to like 5 years ago. I don't think like the typical investor was thinking about this kind of like dilutive event from issuing all this stock. Yeah. They were calculating things like growth and EBIT and stuff like that, often without the stock comp. And now I think it's much more common to be using that as part of the calculation.
Yeah, exactly. These are like really complicated incentive structures, right? Where it's almost comical, right? Like our financial, it boggles my mind how all this stock-based accounting works. But we're paying today. We're accounting for stock that was issued 4 years ago at $20 a share as expense at $20 a share, with the stock trading at just over $5 a share today.
Oh, really? Oh, God. Okay, so that's very complicated.
This is another one I could easily screw up, but like my understanding of it is that the expense that we recognize is based on the price at the time that we issued those shares.
Got it. Okay.
So there's this weird,
and then you've got like a 4-year kind of tail on it.
Yeah, you have like a 4-year tail because most of those grants are like
even if the grants are underwater and no one's ever gonna.
Well, in our case, we use RSUs, so they're not underwater. They're just worth less than when we granted them, and so you have less incentive, but you're still carrying that cost. Yeah. So the types of things we just look at it again, and this won't surprise you based on our conversation. We look at issuance dilution, right? So we look at it and we say, well, how much dilution are we actually creating to ourselves and to our shareholders through all of these different mechanisms? And we should be looking. That's another thing you should, when you're generating cash and you have a lot of cash, you should be looking at is like, a lot of our employees look at these incentive structures as part of their compensation. And so they get a share of stock, they sell a share of stock. They're like, that's stock, right? They don't all look at it as a long-term investment. And so we have to look at it and figure out, should we be issuing, potentially giving them cash instead of stock because they don't.
They might value it in a different way. Yeah, that makes a lot of sense.